The accounting department doesn't exist or do all the good work that they do so that they can create a nice bound book of information to put on a shelf somewhere. Financial statements are created to be used by others, whether internal management or external stakeholders, to make decisions about the company. For example, a Wall Street analyst may be looking at Macy's Inc. as a potential investment candidate and would need to forecast their future income to produce an estimate of the value of Macy's stock. Using forecasts from economists for economic growth, information about new stores Macy's has opened, and any changes in the competitive landscape, the analysts can then make a reasonable forecast of the growth in Macy's sales over the next few years. A key piece of information from the financial statement for her then may be Macy's profit margin, calculated as net income divided by sales. Using her sales forecast and assuming the profit margin stays fairly constant, she can forecast Macy's profit over the next few years. Similarly, a firm may go to the bank to apply for some new borrowing. Before deciding to extend the firm credit or not, the bank will want to look at how much debt the company has already incurred, a figure found on the balance sheet, and a figure the bank can rely on because it's been verified by the auditors. The bank will compare the level of debt the company already has to its assets and probably to its cash flow to determine if the company could support the increase in debt. You may have noticed that in both cases above, the decision maker didn't look at just the raw numbers from the financial statements, but had to do some calculation, some analysis to make them useful. Financial statement figures make the most sense when we look at them in relationship to each other. So the analyst needed to know not just how many dollars of profit Macy's makes each year, but how many dollars of profit they make in relation to how many dollars of sales they generate. When you ask a banker to consider giving you a mortgage for $200,000, it's very important to the banker to know whether your home, the asset, is worth $250,000 or $1 million. Considered in a vacuum, the numbers from a financial statement often don't mean much. But when considered in relation to other numbers, they become very valuable in decision making. The tool of financial analysis, which we're about to develop, is all about looking at the relationships among various financial statement accounts, called financial ratios. We can then use those ratios to compare one company's results or financial condition to a similar company or companies. By evaluating how a company compares to its competitors in the same industry, we can identify whether they are a standout performer or a laggard. To really understand how a company is performing, an analyst or management will want to evaluate how a company's ratios are changing over time, or how they compare to the same points in previous business cycles. By using ratios to make all these comparisons, we can adequately compare companies of different sizes easily, even account for the growth of a single company. Just to review, you can generally access a company's financial statements on their website, investor relations page. Try typing in the name of the company's website and /investor. Most of the time, that URL will take you to the correct page. If not, look at the bottom of the home page for something like About Us or corporate information. Once there, look for a link to annual reports or financial information, and you should find a PDF or HTML version of the annual report, which will include the financial statements. Occasionally, the company simply provides a link to the 10K, which is fine. A very reliable but slightly more time-consuming way to access the 10K is through the SEC's database of corporate filings called EDGAR. On EDGAR, look for the link to search for company filings and then search by company name or stock ticker. You may have to search the list for the parent company to bring up a long list of filings. make it simpler for you, under document type, input 10K and research. It should bring up all the company's annual filings in reverse chronological order. Select the most recent listing and confirm it's for the time period in which you're interested. Once you have the actual 10K report, remember the financial statements and notes are item 8, and the MD&A is item 7. We generally focus our ratio analysis in 4 or 5 areas. Liquidity measures how much cash a company has available, or how easily and quickly its assets will be converted into cash. Will it be able to pay its short-term obligations on time and in full? On the balance sheet, we're effectively looking at, the relationship between these liquid assets and near-term obligations, or maybe both of them in relationship to total assets. Who might be interested in evaluating this information? Banks, certainly, if they have extended or are considering extending a company a line of credit or other short-term borrowing. Vendors will want to watch this carefully. If they provide payment terms to their customers, allowing them time, say 30 days, to pay their invoices after delivery of the vendor's goods and or service. Even employees should pay attention to these measures, as the first indication of a company experiencing financial difficulty is when the firm can't make payroll. That is, they don't have the cash to pay their workers for the labor they have provided. Leverage is a measure of how much debt a company has employed in their capital structure and how able they are to repay it. Here we're focused on the amount of long-term debt usually a company has. Again, probably in relationship to the amount of equity or maybe in relationship to their total assets. Debts are contractual obligations to pay interest to and repay the principal to lenders. If the company cannot meet those obligations when due, the lenders will have a senior claim on the assets and can take control of the company from its owners. Keep in mind, very few lenders want to be in a position of taking over control of the assets. They're in the business of lending money to firms and then getting paid back that money. They have as much interest in making sure their loan customers don't get overextended as the borrowers do. So the primary users of these leverage ratios are lenders of all kind, whether banks or bondholders. Management as well will watch leverage ratios closely, both to avoid trouble, and since determining the optimal mix of debt and equity, their capital structure is a key decision affecting the value of the firm. Management should also watch efficiency ratios closely. These are measures of how well management is using the assets they have been entrusted with. Let's think about, the whole value of their resources compared to oftentimes things like the amount of revenue or the amount of net income that they have made. Efficiency ratios are measures of how well management is using the assets they've been entrusted with for the benefit of the owners. Management's key role is to invest in and productively employ those assets to generate economic returns, profit, cash flow, gains in value that end up accruing to the shareholders. The next group of ratios to consider are profitability measures. That is, just how much money is the company making? But as we mentioned earlier, it's not enough to just know the raw amount of profit. Let's say comparing, just the amount of net income on a company's income statement or their cash flow even. But how does it compare to the amount of assets that the management has at their disposal, or relative to the amount of equity that shareholders have invested. I already mentioned net profit margin. Let's look at net income compared to revenue. Clearly, this is a key metric for investors and for management to follow. In fact, I'll try to show you later that return on equity, net income divided by shareholders' equity, is possibly the key measure to look at for management effectiveness and is the reason that all of the accounting statements are created. The final group of ratios to consider are hybrids between accounting numbers from the financial statements and market-based numbers that we can observe in capital markets. We'll talk about a couple basic valuation ratios here, but later in the course we'll spend far more time talking about the valuable information the capital markets provide. So let's take a look now at each of these 5 areas in turn. The most useful and most common measure of a firm's liquidity is its current ratio, which is calculated as dividing their current assets by current liabilities. Remember, current assets are cash and resources like accounts receivable and inventory that will be turned into cash within 1 year. And current liabilities are those obligations that the firm has to pay with cash within 1 year. So the current ratio measures how many dollars of cash the company has to meet every dollar it owes over the next year. Clearly, the higher the number, the better positioned a company is to meet its obligations. But companies aren't in business to sit on piles of cash. So if their current ratio is too high, it can actually be a negative to management. Historically, analysts wanted to see a current ratio of perhaps 2. In recent decades, though, companies have gotten much more efficient at managing current assets. Think of things like electronic payment systems and better inventory control, just-in-time inventory. So now a ratio of 1.5 would be considered good, maybe even a little high. And a ratio of 1.0 is not necessarily a point of immediate concern any longer. Remember all the accounts included in current assets: cash, cash equivalent, short-term securities, accounts receivable, inventory. Clearly, cash and cash equivalents will provide the amounts we expect and are recorded on the balance sheet. Accounts receivable is amounts we have lent to our customers to purchase our products and services. If we've done a good job of vetting the customers to whom we lend money and have properly reserved some amount for bad debts anyway, the amount recorded on the balance sheet should be pretty accurate as to the amount we should collect. But what about inventory? Can we really realize the amount we expect to for inventory that we hold? If sales are slow, we might have to discount our prices. We might not convert the products to sales as quickly as we hoped. If sales are really bad, we might cut production. And then raw materials inventory will build up, or at least not draw down as quickly as we expected. To address this problem of the limited liquidity of inventory, we use the quick ratio. Mirrors the current ratio, but does not include inventory in the numerator. This gives a much more conservative measure of a company's ability to generate the cash needed to pay its bills. A final measure to consider is net working capital as a percent of total assets. Here we'd be looking at essentially, right, net working capital is the difference between current assets and current liabilities. So we're going to be looking at that difference as a percentage of the total assets that the company has. We'll see later that this is an amount which is generally financed by long-term capital, which is costly. Since short-term assets like cash and inventory don't pay the company interest, financing those assets with costly borrowed capital is not a good strategy. The lower the amount of net working capital that a firm needs to operate, the more efficiently management is managing the assets, and the higher the potential returns to shareholders. If you're like me, seeing these ratios as some algebraic equations is never very enlightening. So when we're together in class, we'll look at some real-world examples. But here I wanted to just introduce the ratios and what they're used for. If we operate from the idea that the role of management is to utilize the firm's assets to produce returns for the shareholders, then it's important to measure the effectiveness at management in doing so. That is the purpose of these efficiency ratios. Evaluating trends and making comparisons to competitors is particularly important in this category. Any individual measure looked at in a vacuum isn't very illuminating. Instead, we need to know if the measure is improving or worsening. Does it indicate that this is a competitive strength vis-a-vis our competitors? Or do we need to look at it, or do we need to look at ways to overcome a deficiency? These ratios can be very specific to industry as well. So it's not appropriate to compare the efficiency ratios of a car manufacturer, for example, to a software developer. Traditional accounting has focused on recording investments in tangible assets like plant and equipment, and has struggled to value investments in intangible assets like innovativeness, patents, and creative idea generation. The first measure to consider is the broadest and the simplest to understand. Asset turnover, calculated as total sales divided by total assets, tells us how many dollars of sales the firm is able to generate for every dollar of assets employed. Although generating sales should not be the primary objective of a firm, making profit from those sales is. We use the sales figure here because the assets are generally used to create a product or a service that the company can sell. Other management activities and policies will determine how those sales are turned into profit. If a firm is able to generate more sales without needing to increase their assets, they will not need to raise new capital, debt or equity, to finance the purchase of more assets. When the sales are turned into economic profit, that higher profit is distributed across the same level of capital employed in the business, increasing the realized return to that capital, and hence the market value of the capital. Consider a small manufacturer who owns one factory filled with equipment and runs one shift each day turning out the firm's widgets. Since the factory and equipment sit idle from 5 p.m. each day until the shift workers return at 8 a.m. the next day, the manager could increase the effectiveness of those assets by running a second shift overnight. It would not require an increase in the investment in plant and equipment, and would increase the product available to generate sales. Of course, the efficacy of that decision depends on there being demand for the product. We can look at any subcategory of assets in this way, depending on what is important to the firm. For that manufacturer I just mentioned, it might make sense to look at just property, plant, and equipment turnover, sales to average property, plant, and equipment. For a short-term lender like a finance company, maybe accounts receivable turnover is most relevant. For retailers and many manufacturers, managing inventory is a critical function. So we measure and evaluate inventory turnover. Conceptually, this tells us how many times a year the firm sells its inventory and then restocks to sell it again. The days inventory turnover flips that relationship over. You can see we're taking the reciprocal of cost of goods sold over average inventory and then multiplying it by 365. Right? So we flip that relationship over, and this calculation tells us how many days on average an item is held in inventory. If we were looking at accounts receivable turnover, it might tell us how many days it takes to collect those receivables. Now, this in particular, there is almost nothing intuitive about these equations that I provided you here. So we'll hold off on a little bit deeper discussion of this until we break down a real-world inventory turnover. So, but first, a couple comments about the nature of these ratios. One, you see that we are now pulling information about assets from the balance sheet and information about revenue and expenses from the income statement. This creates a sort of apples to oranges comparison dilemma. Remember, the balance sheet measures assets as of a specific day, while the income records sales and expenses over the course of a period, a quarter or a year. So we're comparing what happened over a year, for example, to the state of the company as of one day, the last day of the year. The assets the company held on that last day, though, weren't necessarily the assets the company used all year to produce the sales volume we are evaluating. Sales occurred on each and every day, so we would most like to compare the sales for each day to the assets employed on that day. Unfortunately, particularly as external analysts, we don't know the value for assets, or sales for that matter, for every day, so we have to make some assumptions. If we assume that sales occurred relatively smoothly over the course of the year, we might assume that assets increased or decreased relatively smoothly over the year as well. That means we can estimate the average daily assets employed by taking the simple average of the beginning asset figure, that's the end of last fiscal year, and the ending asset figure, the end of this fiscal year. Add the amount reported on last year's balance sheet to the amount reported on this year's balance sheet and divide by 2. If you have quarterly interim figures easily at hand, you might improve the estimate by adding the 3 interim figures to your total of the ending and beginning, and then divide by 5. This goes for any measure of asset category we're looking at. The second point is that although we are interested in discerning the ability of specific assets to generate sales, in the case of inventory in particular, we don't compare, you'll notice in these ratios, the level of inventory to sales, but to the cost of goods sold, COGS. COGS is an expense, right, that's deducted from sales to give us gross profit. COGS is an expense that represents what the firm spent in costs to produce the products or services it recorded as sales. Inventory is recorded on the balance sheet at what it costs to produce or purchase. So the appropriate comparison is to that cost of goods sold. If we used sales in the numerator of inventory turnover, we would be building into the ratio the firm's gross profit margin, and that would distort the analysis. As another example, if we're looking at accounts receivable turnover, the appropriate comparison would likely be to just sales made on credit, not total sales, since only credit sales generate accounts receivable. The leverage ratios turn to the attention to the other side of the balance sheet. Right? We're going to start looking at debt in particular in relative to the amount of equity. Here we focus on whether and to what extent management has chosen to finance their assets with borrowing versus equity. The greater the amount of debt, the more financial leverage the firm has employed, and the riskier an investment in the firm is. Because the obligation to repay debt is mandatory and generally a fixed amount of dollars, any downturn in the firm's results is magnified. A reduced amount of cash flowing into the firm from its operations means a greater percentage is needed to pay that fixed debt service, and it results in an even greater percentage reduction in the cash flow available to owners. Of course, the flip side is also true. When results are better than expected, the firm does not owe additional amounts to debt holders, and the result is a greater percentage in the cash flow to shareholders. Since the value of a shareholder's interest is determined by the cash flow to which he or she is entitled, any increases in cash flow directly increase the stock value. So, judicious use of debt is a real benefit to creating shareholder value. The two key leverage ratios are the debt ratio and the leverage ratio. They are directly correlated as they each just use two of the three components of the accounting equality. Remember, assets equal to liabilities plus equity. For the debt ratio, we divide total liabilities by total assets to get a figure representing the percentage of the firm's assets they have financed by borrowing. Consider the size of this box, right, to the total of those boxes. Most firms maintain a debt ratio of 30 to 50% in general. But those with very few tangible assets or highly uncertain cash flows, think a biotech company, might have little to no debt. Conversely, a firm with large investments in tangible plant and equipment and or highly stable cash flows, think ComEd, any utility company, might have a debt ratio of 80%. On occasion, it might be meaningful just to look at a company's ratio of long-term debt to total assets, which ignores their use of current liabilities to finance current assets. Right, so here I'm saying we would be ignoring these near-term obligations and maybe even some parts of these, long-term debt, long-term liabilities. The leverage ratio looks at the same relationship from a slightly different angle. The leverage ratio divides total assets, right? Add up all of these boxes by shareholders' equity. This produces a measure of how much in assets each dollar of equity controls. Obviously, the more productive earning assets upon which you are entitled to the earnings, or at least the net earnings, the more valuable your potential payoff. For the same reason, if those assets fall in value, that is, their earnings power declines, the value of your investment will decline even more. By deconstructing the accounting equality, doing some algebra, you can see that the debt ratio and the leverage ratio effectively tell us the same thing. A high debt ratio will produce a high leverage ratio, and a low debt ratio will produce a low leverage ratio. Another way to see how onerous a firm's debt load is to measure their ability to pay the debt service, the annual interest on the debt, out of their operating earnings. If you think in personal finance, this is often measured by a debt-to-income ratio, which looks at your monthly loan payments as a percent of your monthly salary. If you've refinanced a mortgage recently or tried to take out a new loan, that's one of the first things the bankers will look at. In corporate finance, we look at the times interest earned ratio. This starts with a company's operating earnings. Remember, I called that EBIT, E-B-I-T, which is earnings before deducting interest costs and the taxes due. A better measure, in my opinion, might be cash flow from operations from the statement of cash flows, but tradition and textbooks are hard to change. The amount of operating earnings is then compared to interest expense from the income statement. Again, the amount paid in cash for interest is usually available in the notes to the financial statement if you want to calculate a pure cash flow measure of this ratio. The greater the level of annual operating earnings to a company's annual interest expense, the less likely are they to fall into financial distress from a downturn in their operating results. This is just the inverse of that debt to income ratio I mentioned earlier in personal finance. If your requirements to pay monthly principal and interest on your mortgage, your car loan, and your student loans is too high a percentage of your monthly income, then you're unlikely to have much flexibility to weather a cut in your take-home pay. The final category of accounting ratios, we'll talk about valuation ratios as well, is perhaps the most important, or at least the most interesting and most talked about to most observers. Profitability ratios tell us how well management is doing at their objective of producing returns for shareholders from their investments in assets. So these are critical measures for investors to follow. From the inherent structure of the income statement, we can determine various levels of the profitability or the return on sales. In fact, many firms put this calculation right on the income statement by showing each line as a percentage of sales. Remember that by categorizing expenses into cost of sales, operating expenses, and non-operating expenses like interest and taxes, the income statement gives the reader a few intermediate measures of profit. And by dividing each intermediate measure by sales, we have a measure that tells us of each $1 of sales, how much of that measure of profit is generated. Focusing just on the bottom line first, because it gets the most attention, by dividing net income by total sales, we know how much of every dollar of sales is left over for the shareholders. This measure may also be called return on sales. And the paucity of that number in most cases may surprise you. When you go into a store and spend $100, the net profit margin is how much the owner ends up with in her pocket. In most cases, it's less than $5. I've mentioned several times, management's role is to produce economic returns on the assets employed in the business. So return on assets is a key ratio to follow. You might think that net income would represent the return on assets, but net income is the return that is left over to belong to shareholders after the other capital providers, specifically lenders, have been paid. This is a good place to make a second comment about ratios in general. You will sometimes see return on assets calculated as strictly net income over average total assets. I disagree with that view, and I prefer this. It's always important to know, to look at the definition. It's always important to know, to look at the definition of ratios if you're looking at them, to see what the analyst or the author has used. There can be differences. Some don't use the average assets. They might only use ending assets. So know what is recommended, or know what is being used in any ratio calculation. As long as you're consistent with what you do, it will provide you reasonable information. So getting back to return on assets in particular, to calculate the return on assets from financial statement data, in my opinion, we need to include the returns paid to all capital providers. So we add the interest paid by the firm to net income. Net income belongs to the shareholders. Interest belongs to the lenders. We'll spend a lot of time talking about this chart later in the course, where all of the returns from the assets belong to either lenders or shareholders. And that's why when I talk about return on assets, I'm always including interest in that net income figure. Again, we're looking here, we're comparing a flow measure of income and expenses from the income statement to a snapshot of assets at a point in time. So we should use average assets over the period measured by the income statement for the best estimate of return on assets. Finally, we come to return on equity, or ROE, which is the ultimate measure of how management, as an agent, has done for the shareholders, the principals. Net income is the accounting measure of what returns are attributable to the shareholders, and shareholders' equity is the accounting measure of the historical amount invested in the firm by or on behalf of shareholders. ROE, therefore, measures how well management has done at generating returns from the dollars invested in the firm by owners. ROE measures how well management has done at generating returns from the dollars invested in the firm by the owners. Yes, I repeated that. I always like to emphasize that ROE does not measure the return an investor has earned from buying a company's common stock. That return is based on the price the investor paid, likely in a transaction with another investor, not the company, and the dividends the investor has received, and what the market says the value of the company is today. None of those items are included in this ratio return on equity, which is purely an accounting measure of management's performance. None of that is to say that return on equity isn't important or valid. It is both. You just must understand what it actually measures, not what it sounds like it measures. While we're on the topic of the stock market, I think it's a good point to consider common valuation ratios, mainly the price to earnings, or PE ratio. You often hear this commonly quoted in discussions about the stock market and about the relative attractiveness or unattractiveness of a particular stock or segment of the stock market or the market as a whole. The PE ratio tells an investor how much he has to pay for the rights to own $1 of a company's earnings. That's what an equity investment entitles to, your pro rata share of the company's earnings. So the more you have to pay to buy that $1 of earnings, the more expensive the stock is. Not necessarily, but we'll spend much more time on that later in the course. If you're considering investing in either of two companies, presumably you want to buy the one that has a lower price for each dollar of earnings you're buying. I have hinted at times that the value of a company's common stock is determined by the amount of its earnings, so the PE ratio seems logical to consider, as it is strictly the relationship between the market value of the stock and its earnings. Notice one key difference between this and all the other ratios we have discussed. The PE ratio is not based strictly on accounting or book numbers. Only earnings per share comes from the accounting records. It also incorporates a market-based number, improving its relevance to financial decision making. In one sense, PE ratios are a measure of market sentiment. When investors are enthusiastically buying stocks, the price of those stocks rise whether the accounting numbers, say earnings per share or financial fundamentals, cash flow, have improved or not. So PE ratios for individual companies and for the market will rise. Conversely, during a bear market in stocks, when everyone is seemingly pessimistic, selling will drive down prices and PE ratios will fall. So what's a typical range? It's very hard to say. PE ratios can vary dramatically, especially for individual companies, and that's something that we'll talk about again later in the course. In general, though, recent history has seen PE ratios centered around 18 times to 25 times. Right? That means to buy $1 of earnings, you have to pay $18 for the stock or $25 for the stock. We'll spend more time later understanding what influences those PE ratios and how to truly evaluate the implications of a particular result or differences between companies. So profits versus cash flow, which is more important to a company and to its investors? You've probably always been led to believe that profits are the key to business success. And over the very long term, that is certainly true. A company cannot survive and prosper if it cannot generate accounting profits. But profits, as an accounting term, are an artifice of the accounting process, which involves many assumptions, estimates, and smoothing techniques, so that the reported profits for any single period will represent a typical or representative level of earnings for the company over time. And the flexibility given to management to adjust those estimates and assumptions has led to some clear abuses at times where earnings do not truly represent a representative level of earnings. In fact, the phrase cash is king is absolutely true in finance. You will see later that we are concerned always with cash flow, not profits, in most financial analysis, whether it be capital investment evaluations or security valuation. Now, it is certainly true that cash in minus cash out will approximate net income, but only over very long time periods. I mentioned in a previous presentation, cash in minus cash out will only equal net income, most likely over the entire lifespan of a company. Most investors can't wait that long to have good information for analyzing a company's results. So, companies now provide investors with a statement of cash flows to supplement the income statement. And from the statement of cash flows, we can make an estimate of the cash available to capital providers in any given period, which is what really matters for valuation purposes, and is certainly less prone to manipulation by management, as there are no estimates involved, just cold, hard facts. How much is in the bank at the beginning and how much is in the bank account at the end. So rather than comparing a company's stock price to its reported accounting numbers via PE ratio, many analysts will also, or instead, calculate a price to cash flows ratio. This tells us the same concept as the PE ratios, but it calculates how many dollars of stock price we are paying for each dollar of cash flow, not each dollar of possibly suspect earnings. There are many different ways to determine cash flow. This is another one where the ratio, you really need to know what's been defined. Every analyst will have their own favorite, but the most common is what's known as free cash flow, and it's calculated as cash flow from operations, one of the three lines in the cash flow statement, minus a company's reported capital expenditures, also found on the cash flow statement in the cash flow from investment section. So the idea of free cash flow being net operating cash flow minus CapEx is based on the idea that a company has to make continual investments in productive resources to replace old deteriorating assets and to grow through embracing new technologies. So if we want to estimate the amount of cash flow available to the capital providers as the amount of cash generated running the basic business day to day, less the amount needed on an ongoing basis in capital investments. Sometimes that is estimated by EBITDA, right? Earnings before interest and taxes, adding plus depreciation and amortization, adding that back. EBITDA is an estimate from the accounting records of cash flow. In my opinion, if you've got the cash flow statement, we can get better estimates than EBITDA. Sometimes in free cash flow, analysts will also subtract out stock dividends in the idea that they are basically required, right? They're not legally required, but they are. Once a company begins paying dividends, it's very difficult to stop or to reduce them.